Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, Smart Property Investment. I hope you're well. I'm going to get straight into it today because I have someone in the studio, a regular guest, and typically we run out of time when I bring him in because we start rabbiting on and exploring a whole bunch of different things. So without further ado, Arjun Paliwal, founder and the managing director of InvestorKit, in the studio. Today we're going to talk about those 5 traits that he sees the best investors do as we reflect on the financial year which has just passed and we look forward into a vibrant and prosperous financial year 2026. Arjun, how you going?
Yeah, good, mate. It's great to be on again.
I know. You're here all the time.
I know.
And I hear your voice everywhere on the Property Nerds. It's
Yes.
still kicking goals there.
Yeah, we actually, if I'm not mistaken, we've gone from monthly to fortnightly to weekly. It's been tiring, exhausting as well to get all those episode volumes up, but I think it's only come up as a core thing because of how popular it's been and how many people have said, hey, look, we want to hear more from you guys. So I'm really grateful for that, and we're getting it out there each week.
Why would people listen to Property Nerds other than your nerds?
Yeah, I think the two biggest differences is that we're bringing alive what you would typically see in spreadsheets, bar graphs, and charts to conversation.
Yeah.
And I think that's firstly not the most easiest thing to do. So to be doing that a couple of years in, we've gotten a bit of practice to go, hey, how can we take these key trends and bring them to life? But the second is the caliber of the guests. Like the last couple of years, we've had it as in myself behind the mic and my co-hosts, and we've kind of kept it to us two. But now we're like, hey, let's actually touch every aspect of someone's portfolio journey. So we've got someone in the finance seat being Jack, and then we've got myself in the property side and data. Then we've also got the strategy side covered from portfolio strategy in isolation. And then we have a spare seat for each of the guests that come in from economist backgrounds. We had Cam Cusher recently from the REA Group. We've got Nerida Conisbee joining us soon from Ray White. So we're trying to bring in the biggest and the best names as we can in data, specifically data, but then surround that with finance, property, and strategy. So it's this unique mix. And I think that if people are seeking that data deep dive, but still touch those other elements, so it's all well-rounded, it's the place to tune in.
So how much of your time now steering InvestorKit is talking on podcasts and broadcasting? And I saw a thing on your social media. You're starting to do something with, is it with Channel 7? Did I say that right?
Yeah, it's with Channel 9.
Channel 9, sorry.
That's all good.
Yeah. Great channel, Channel 9.
Yeah, it's been special. So we've got an arrangement together that's got us on the Weekend Today show. So I'm a new commentator on there every single month, every mid-Sunday of the month, sort of in the mornings. And
so you got to go to the studio on a Sunday.
Yeah. So Sunday's still work day for me. Sunday morning, suit up and into the North Sydney. But what's really been cool, a couple of points to reflect on has been, for all my, I joke about this, for all my fellow curries, the Indians. Are
you allowed to say that?
Yeah, we can say that to ourselves. So for all my fellow curries, like representing the brown boys, that we're it's the first time someone's got that sort of regular spot in the property industry of that. But then secondly, it's really putting the buyer's agency industry on the map. I really want to make sure we're representing and helping buyers recognize that there's better ways to invest. There's more data out there. There's better ways to read the data. And so trying to rep all things, really.
Well, I'll let you rep that first thing. I'm not going to offer any commentary on it, but I do note, your rapid growth as a professional, and you're very well considered regarding the work that you do. And if you want to sort of big it up to the game, that's sweet. I think it's cool. But on the second side, there is a cohort of interconnected professionals, I'd like to think myself included, which are trying to help at a formative time in its real growth. Just giving a sense to what buyer's agency means and how that career will transition and progress. Still has a long way to go and still finding its feet. So it's good to see you out there at Channel 9 and showing that and highlighting that. And you're very data driven. So I think that will be a really nice place for you to sort of continue to shape your decision making around where you're making your investment decisions. And you're still head of research of InvestorKit, aren't you? And I think the name is on the tin. I think within Momentum Media, one of my sort of titles is still head of content, because we're in a business of making information, right? You're in the business of shaping and crafting data to make investment decisions. So, it's all very important, no doubt an important role. But in your cohort of investors who you service, we're talking about the 5 key traits of of what they do, and this is sort of as a reflection on this current financial year that's just gone past and the one that we're now moving into. Is it that simple to get property investment right if you just look at what the best are doing? You don't need to reinvent the wheel, do you?
Yeah, so there's a couple of common assumptions, right? Firstly, there's the old income, cash, savings ability each month. Let's put everyone in their own race and not compare there, because I think, everyone's got different starting points, everyone's got different end goals. So if we put that aside, what I would say firstly is now let's look at the rest. And the rest are the traits, mindset, habits, actions they take, their viewpoint on things. And so the whole point of me diving into the 5 traits in particular is that if you go to the best in your portfolio of clients, and I'm talking those with multi-8-figure valued portfolios, $20, $30 million in assets, then to even those with 10, 15 plus properties. You've got the quantity people, you've also got the residential and commercial, and you've also got the view of dollar value base. And while you look at all of this, you don't just say, well, I don't have that, or I don't want that, I don't want to do this. You want to pick the traits that are the best amongst these individuals and families and say, well, if I could bring that into my world, even if it is to have a comfortable retirement with 2, 3, or 4 investment properties, you could be doing it a lot better following these traits. So that's why I really wanted to dive into them and go into understanding what's there.
So I would say then that the traits aren't largely contingent to only, or they're not unique to those people with large portfolios. However, it would be these traits which allow people to scale large portfolios. So how many of your client base, how many people are sort of walking around with $20, $30 million value portfolio? So, well, I'm not looking at the debt position as in the value of the portfolio. Is there many of them out there?
So if we look at the broad percentages of things, no, there is not that many of them out there. But then if you look at them down to the percentages of our, who we liaise with and who we deal with, suddenly the percentage starts creeping up. Because I think that's also one thing people need to, I guess, not be too hard on themselves for, is that they might hear some of the stories I talk about today and go, oh, well, why can't I get there? Or why don't I have that number? You've got to realize that it's the 0.00001% of Australians that are in this mix. But at the same time, it's quite common in the group of people that we talk to or talk about. And so if you're tuning to this show, you're going to be like, well, this feels like, it's quite normal, but it's not. I just want to make sure that's clear.
Yeah, and this is a sense of perspective I sometimes need to recalibrate as the host of this show, and we did a reader survey, and it come back to me, because you sort of immerse yourself with people who are in and around property who have large portfolios, you get conditioned, or it becomes normalized, that when you start talking about multi-8-figure portfolios, 20, 30, 40, $50 million, you sort of just, you start getting a bit flippant with it, and you think it's normal. It's not normal. Those people who actually have those portfolios, and to the point we'll chat about today, have probably been very deliberate and methodical in how they've gone about building it. So there are some traits there. Success leaves clues, as we know. So let's break that down. But put it in perspective, if you don't have a $10 million, $20 million portfolio, it doesn't mean that you're not doing a good job as a property investor.
That's it.
The stats say that most Australian property investors will have between 1 and 2 properties. And if you end up with 6 investment properties, I think there's only 35,000 people with that in Australia. So you're in a very sort of select group of people. So it's normal to think that 2 to 3 properties, 4 properties is very, very normal. So that's how we should frame it. But what can we learn from the best, Arjun? What would be the first thing?
Yeah, so the first trait is actually as simple as diversity in asset types and diversity in locations. And so this was very common amongst the multi-8-figure portfolios we reviewed. And if I go through diversity, I'll break it down in asset type and location. So from asset type, we're talking residential and commercial properties. And the most common reason I found that switch over was that they all didn't want a bunch of roofs, kitchens, bathrooms to think about for their whole holding period, which is a long time. Even they realize money's not made quick, it's made over time. So they don't want a whole bunch of those. Secondly, there's something called efficiency of capital. If your capital is driven on a growth driver and you're trying to use leverage, then residential real estate's where it's at, because you're leveraging up to 90% at times and you're able to use less dollars to buy that same asset type. But then heading into commercial, really the core focus here is income. And secondly, to scale the income even as the prices go up. One thing that happens in residential is if you go from 1 to 2 to 3 to 4 and $5 million asset prices, your rents as a percentage of the purchase price just shoot down, lower rental yields. But you can keep that same, say, 6% number if you wanted to as a net yield value all the way up, even if you go into the millions. So diversity was the first part, basically an asset type. The second trait I noticed was diversity in location. What I found is that they were open to capital cities and regional centers, but as they diversified, what was more important than, just the specific hotspot flavor was a combination of the hotspots at the start to make sure they picked out the right markets for great value and great growth. But then it became less and less important the more assets they had in their portfolio. It became more about, could I plant a flag in each different part of the country? Because once you do get to around 5 properties and you say have taken that 5 properties in 5 states approach, very rarely in history moving forward long term is an event to strike that hits all 5 properties for a long-term period of weakness across all 5 states all the time. We see such diversity in performance. To put into context, it's probably twice in the last 50 years where we've seen all markets move, say, backwards or forwards at the same rate of growth or the same rate of decline everywhere. And so when you know that is a 48-year odds in your favor of 48 times out of the last 50 years that this has happened, then all of a sudden you go, well, why am I not doing this? Why am I not diverse? And so then at that point, it just becomes less about what's happening in any given market. And they just feel like, well, I don't actually have to think anymore about what the market does because I'm just putting my faith into an asset class and long term because I'm now more than those 3 or 4 cities.
So I'm a real simple guy and not very bright. What you're saying here is don't put all your eggs in one basket.
Absolutely. Both in asset type and location.
Yeah. So commercial, resi or resi units, houses, commercial, industrial, retail, office, in resi, regional, metro, et cetera. So makes sense. That means you're not clustered or you're not at an aggregate level overexposed in one particular area, going long in one particular area. It means you've got plenty out there. Okay, that makes sense. Number 2, Arjun, but before we go to the second trait, we'll just go to a quick break. Stay with us, back in a moment. Welcome back, Phil Tarrant, host of the Smart Property Investment Show. I'm with Arjun Paliwal, head of research, founder, InvestorKit, making waves all over the place. There's nowhere I don't see you not on social media, mate, telling me about something going on. And thank you so much for sharing your insights, particularly from a data-driven approach where you've really cemented yourself as a sound operator inside of the property strategy space. Now, we're talking about the top 5 traits of the top investors as we reflect on a transition of our financial years. What is number 2, mate?
Mate, number 2 is sweat the small stuff in strategy. Don't sweat the small stuff at an asset level. So I found a common trait amongst them was really doubling down on the questions, the insights, where they're trying to go with the strategy. And by strategy, I mean, where's your portfolio trying to grow? What's the end level of assets you're trying to get to? What's the end level of income or wealth that you're trying to get to? By what age? And they would sweat all the small stuff there. Well, what if I purchase 2 assets faster? Or what if I spread them out? What if we transition to commercial at this point in time? What if we actually don't do $2 million price points or $1 million price points? What if we do 2 800s? So everything was really sweating the small stuff at strategy because to them it's like, can I get all the right pieces in order? So I have reasoning as to which locations, what price points, residential, commercial, how frequent, how many, because they don't want to turn this into I'm addicted to property and I just keep going because I have the means to go to it. They want to do what's optimal for them to get to their result. But then as soon as I went to the asset level, the sweating just stopped. There wasn't like a conversation or a deep dive and discussion around, the direction facing of this property, the shape of the block, whether it was brick, weatherboard, beds and bathroom, whether they go 3 suburbs in or 3 suburbs to the right, or whether the tenant was, under rented or not, or when could they increase it. All of these things just didn't matter to them. For them, it was like, well, it passes due diligence, right? You're the team member here helping me for that. It's in a market where you feel the research is strong and well placed, and you've done a comparable price and rent analysis, giving me the cash flow so I know my numbers, and we have clauses of finance and building in place to protect ourselves. What am I going to do? Like, what else am I going to ask? And you're not coming here, Arjun, talking to me about how to do brain surgery or asking me all the questions. And when I do that for my patients in that sort of way, you'll have curiosity about the process. You want to know, make sure you're in good hands. But the core thing is, like, I just want to make sure my strategy's sound. So I found a really common theme that we spent almost triple the time on strategy, dissecting the ways. We took about more sessions than any other type of client to be able to get that strategy perfect. But then as soon as it came to the asset, it was like a 10-minute conversation that said, makes sense to me.
What you're talking there, and I've used this logic beforehand, as a property investor, particularly if you want to be serious about it, you need to think, act and operate like a CEO. So you're in charge and ultimately accountable for the outcome. What the best CEOs do is they surround themselves with the smart people. So the CEO will set the strategy and the direction in lockstep with their key executives. However, they'll push down the execution of it to the people who are best fit and geared to do the execution. That's exactly what you're talking about there. So the property investor owning the outcome of where they want to go and strategically why, where, when, how, and everything relevant with it. But then on the actual tactical execution, yes, they're accountable for that. However, they'll rely on the right person to get the job done. So in your case, it'd be InvestorKit, where they'd give you, this is what we're trying to achieve. I'm empowering you to go and sort of hit it.
Absolutely. And so that's a really good analogy, looking at the CEO as a business, because property is a business. You've got an assets and liabilities. You've got a profit and income center, cost center. You've got a team, so that's really
everything.
putting it together.
Yeah. And it's what I always say, property's the great Australian side hustle, right? People trying to make money outside of their 9-to-5 job. They might start drop shipping or they learn some course online to try and the best way to go about it, if you want to be a business owner without a lot of the challenges and issues of being an SME business owner or a micro business, run a property business, your own. I tell you what, it's a lot more forgiving, a lot less headaches, and you can be the master of your own destiny. It's exciting. Number 3, Arjun, of the top traits.
Well, number 3 was something I was really surprised by as I went through the details, and it was yield percentages aren't a key concern. You'd think that the CEO of the business wants a certain return on their asset and they want to look at it with certain percentages and metrics, and it's hard, get this percentage or don't get it at all. But then I just try to understand from their thinking, yield wasn't a concern to them. Now, it's not because they could handle better or worse cash flows. It's because they looked at the percentage down to the dollar per week level and weren't stressing about it in that way. So to give you an example, if you take a $750,000 property, and let's just say you're looking for a 4% yield minimum, that is a per week rent of $576 per week.
Yep.
Now, if you take that same $750,000 in property, and then you don't look at it from a 4% yield, you look at it from a 3.75. Firstly, there's a couple of things happening here. Number one, you're only getting $540 a week rather than $577. But mentally, when someone just talks in percentages, the 4 and a 3.75 feel so far apart. Secondly, psychologically, something starting with a 3 seems horrible. Something starting with a 4 doesn't seem horrible. But then when they break it down to the actual per week impact, it's $36 per week pre-property management. So probably low 30s. And then that's also pre-tax. So it's even less on the net. So from that perspective, they're like, well, if I was open to 3.75 instead of 4, does that open up 2 or 3 more cities for me? Does that open up 5 to 10 more suburbs for me? And you're telling me that to get this asset that you like for other reasons, I only have to pay $30 before tax, but after management costs?
Yeah.
So this way of thinking just makes me realize that they don't look at these percentage numbers like a P&L sheet in that way. They're actually breaking it down to what's the actual impact per week.
So they're making it tangible rather than a benchmark. And look at the smart property portfolio. You look at yields 4 different ways. I looked at it the other day. What is yield on the purchase price? What is the yield on the establishment price? What is the yield on the current value of the property? And it gives you all the different number. And you say, so what? I always go to the bottom and say, what's it cost me a week? What does it actually cost me a week? And you go, $30. Okay, well, it's a good pub feed, right?
Yeah.
Is that manageable? It's manageable. It makes it tangible.
Absolutely.
And therefore tactile. And if it's tactile, you can do something about it rather than just going, I'll only invest in properties that get me a 3.9% yield or above. Well, what you're saying there is that if you frame your investment decision making that way, it may negatively influence the type of assets that you're buying because you're only going to invest in those things which offer a particular percentage return. And I tell you what, you can go up the Broken Hill and get 10%, right?
Yeah.
But might not necessarily be giving you the capital growth. So That's a really good. I think that's a really good lesson.
Yeah, and they want to just be well measured, as in they want to know what they're getting and missing out on.
Yeah.
So that was a big one. They didn't handle it with a directive. It wasn't this, I need 4.5 and above. I want to manage my cash flows. So percentage and using that wording, and then also using the wording of cash flows. These words just feel fancy in conversation. Like, oh, got to manage my cash flow, so I want that. But if you told someone, let's just talk about it in English.
Yeah.
So $25 a week, but you get to look at 4 more cities and you get to look at maybe 20 more properties to make the best decision.
Pre-tax.
Pre-tax. So, yeah.
What I would say, though, I imagine the benchmarking percentages are a lot more relevant inside of commercial property rather than resi.
Yeah, so commercial property, when you're talking percentages, they're a little bit more important also for 2 reasons. Number one is it's actually not the same per week dollars. When you're talking that 0.5% of yield, it might be on a $3 or $4 million asset. So you're talking some variances there. But secondly, I think at the same time, you have another layer of review. Instead of the layer of cities, you now also have the layer of industry type and tenant type. For example, if someone goes to me, hey, we can get you the 6.5% or 7%, but it's a retail or an office in this building, versus someone goes, well, here's 5.75, tenant's been there for 10 years, 6 years remaining on the lease, and it's a medical asset in a major regional center with only 2 other competitors. Suddenly your yield focus also shifts there. So I think it's a common trait whether you take it to residential or commercial, is that it's the mindset of that investor to know what am I missing or getting on the other side if I just make this dial shift in percentage of yield. So don't give me the blinkers, show me what's there and I'll make the call.
Yeah. And you're doing a lot more in the commercial space these days?
Absolutely. So we're doing about, initially maybe 5 years ago, we were doing about 5% of our transactions in commercial. We're doing close to 20% now of our transactions in commercial.
So, and while I got you, I know it's probably for another time, but what are you liking in commercial world at the moment?
Yeah, so the 2 favorites that we're still getting, that sort of 6% net cap rates and higher, are large industrial sites in major regional centres.
Can you just explain cap rate just for those people that might not be familiar with
Yeah,
that?
sure. So if you look at a $1 million example and you talk, say, 6% net, we're talking $60,000 rent after expenses like bills that you'd have on a property traditionally, rates, water, insurances, taxes even, depending on how the lease is structured. So that's about your 6 at $1 million. And that 6% as an example can keep sticking with you even as assets rise in value in comparison to where residential, people start to fade away from renting those types of assets, where even as businesses get bigger and bigger, they still have the same requirement of space, but just at a larger footprint, and they're willing to pay a similar percentage as a result. Okay. So we're seeing industrial still be quite popular for us, but we're noticing that we're seeing a bit of a return of medicals yields. We had a huge crunch in the yield in some medical assets where it was quite common to be in that 5 to 6% range. But we're finding that, we're still able to get that 6 to 7 in many regional centers. Major stuff, not smaller towns. I'm talking whether it be the Toowoomba's or parts of Newcastle, as an example, have been some recent acquisitions for us, where we're still touching a lot of that 6 and above net yield. And we're still talking, multi-million-dollar assets. The yields aren't fading. So we're having some pretty healthy numbers show up in commercial. And I think the popularity of that asset class is going to even pick up even more as interest rates are trending down. That multiple of what it does for your cash flows is better. But I think the biggest thing for commercial, what I've noticed amongst our top clients, is that they're using it as what I call a treasury management strategy. It's like they're speaking to their CFO, they're running businesses, they're looking at their pool of funds for, we'll get a little technical here, 3 or 6 months of OPEX. So they're running expenses in a business and going, hey, can I keep aside 3 or 6 or 9 months, depending on what them and their CFO have agreed? They've drawn this line down and said, I've got that pool of funds sitting in my business. Then the next pool of funds is they've got a revenue and profit target for the next FY, and they're keeping aside future thoughts around tax payments so they can feel a little bit more fluid, knowing that they've got money for tax and expenses. And then they've got this pool left over. And what we're noticing is that those business owners, every time they get that pool of sort of 1.4 to 2 million in cash holdings in that business, they're calling us up as our clients and going, we're ready to go again for another $3 to $4.5 million commercial property.
So 1.5 to 2 million, you get your sort of 4.5, 70% land.
Exactly.
Yeah.
And so business owners are
you're getting good assets. At 4, you're getting good assets.
Yeah. I mean, we just recently secured a 7,000 square meter site in a corner block in Toowoomba. And that particular property was $4 million, just over 6% net, and a major industrial site too.
Industrial, was it?
Yeah, major industrial site too. And so what we're finding is that as soon as business owners are getting to that sort of 1.4 mil plus in cash beyond their everyday expense management and tax bill management, they're using that as a vehicle to go, well, do I want to pay tax on this, pull it out personally, increase my tax rates from corporate tax rates of 25% up to 40 plus? Or do I want to have entities set up with the advice of my accountant so I can still keep them at a corporate level and buy commercial property?
So essentially, it's getting a bit technical, but they're keeping that contingent profit domiciled inside of the company. So they're building out subsidiary companies in that business and buying the assets under that business.
Yeah, absolutely. And with that, one point to share as
That's
well.
That's not advice at all, by the way.
No, not advice at all. Well, one thing that's really important to note is that if you are getting 6% net on that $4 million example, you're getting about 4.4% return on your invested capital of 1.4. So if you're looking at bank accounts these days, even with some cash management accounts at high interest rates, they're starting with a 4. Return. Right? So if you're getting a 4 in just a cash account, but you're getting the same 4 plus in positive cash flow, plus the growth on the asset of 4 million and the rents continue to rise, business owners are now starting to go, interest rates are likely to trend down. Why would I hold it in my savings account? I'm going to start to move that money over to commercial, still get that high savings account return, plus rent increase in value growth.
I think we could talk a lot more about commercial. We're just touching at the moment. Let's go to another break. When we come back, points 4 and 5. Stay with us. Welcome back, Phil Tarrant, Smart Property Investment, Arjun, Paliwal from InvestorKit. Now, the 3 really good traits the top investors are doing. I like it, Arjun. There's 2 more as we sort of have a look towards this podcast. Number 4, what do you see?
Yeah, so they are acting when they can and using a checklist to act rather than acting when, the horoscope says it's perfect or the seasons are perfect or it's springtime or when, they feel good about their business and how things are going or feel good about their job and the prospects of the economy or the news. There's wars, not wars, or anything going on in the world. For them, it's all about a checklist. And acting when they can has meant that they just make it real boring, make it routine. So an example of the things to consider that they often do is how much cash buffer do I have to make sure I'm sufficiently managing my numbers in case repairs, maintenance, vacancy, and things come up. And I often find the sweet spot there is 20 to 25K loose cash per property, assuming the property value is around 5 to 700K, right? So that's one rule. Yeah.
What, sitting in an offset or having appreciation that forward-looking cash flow would facilitate that?
Offset balances, And it's usually offsetting their home, just sitting there. Or if they're investing, it's across multiple investments. So that's one part. I've got buffer for it. Second is, can they borrow? Third is, do they have the cash flow to sustain any losses that might be there from, say, an asset in today's interest rates? Oh, look, I can save a few thousand a month on top of already having those losses for the next purchase. Yep. And so they've got savings per month, cash in bank, borrowing capacity, and then equity. Now, some don't actually even have the savings cash sitting there liquid. They liquidate it from equity, use a large chunk for purchasing the next property, but then they leave some of that equity aside in offset accounts as a forward-looking buffer from equity they've taken out.
Yeah, and I know a lot of people do that. They'll sit there and they might be sort of, not have a lot of fat kicking around and in offsets, but you've always got the contingent equity. You can always refinance, leverage it for keep buying, and then park some of it, right, for a rainy day, which is a nice place
absolutely.
to be.
I mean, if you have 200 equity that you pull out and you leave 120 to 150 for the purchasing cost, as an example, for a 600-700K property at 90% loans, you can leave the rest of it behind in that offset, just sitting there in case of emergencies. But it's better than you waiting for multiple years to save up that rainy day money and you've been able to add another acquisition. So for them, it's really a boring checklist. It's not this, I need to wait for everything to be perfect. It's literally just ticking these boxes and being ready.
Imagine that checklist also as a plan, because you might go, I've got that, I've got that, I've got that, I don't have that. How do I fix that up? And then I'm ready to roll.
Yeah, absolutely. It tells you where the gaps are. Yeah. It's like that CEO example, right? I'm not going to make that next business acquisition. I'm not going to make that key hire until I have A, B, or C. And then they can kind of turn it into that way.
Just back to that point around commercial properties, are mainly SME business owners who are deploying that sort of capital into commercial property?
It's usually 3 people that we've noticed. So medical professionals, but they're not in the business. They're in high salaries and
like doctors. And this
like
is the challenge with doctors, right? Doctors, they stopped a lot of the ways doctors used to get really wealthy. They've got it all operated under their own names as PAYG type operators, right? Which is the challenge. But medical operators.
Medical operators. We're seeing really high income sales professionals as well.
Okay. What would you say is a high income?
I'd say between 300 and 600K in incomes. Okay. So sales professionals in senior corporate roles or B2B sales, tech sales. That's been a big one. So something's happening in the Salesforce towers. They're all doing quite well over there. So a few people there. But, tech sales overall, medical professionals, and then also we're seeing the business owners, which is the most common cohort. And then the last one we're seeing is like partners of certain firms, but not quite, I started the business or I'm an owner in the business from the whole amount in terms of from the get-go. They're usually salaried, but then worked their way up to senior corporate statuses and their partner levels or high corporate roles.
So
But
they don't have
there.
equity in businesses, but they're trying to manufacture it out of it. They're the ideal sort of side hustlers, right?
Yeah.
That's good. Constant time, Arjun. Point number 5 of the fifth sort of trait you see.
They never do it alone.
Yeah.
There's always a team around them. Like there is a high proportion of people in that mix who've achieved those multi-8-figure portfolios, who have multiple properties, who just want the team around them. Like they just don't go at it alone. And funnily enough, we've seen a few clients in recent times had some stories where they'd bought a couple from us. It'd gone really well. But then they thought, well, hey, I do the math and buyer's agents aren't cheap. You put the fees of 1, 2, 3, 4 together and you're like, could I maybe roll up the sleeves and give this a go? They've given it a go. We've had our review session. They've come back and go, can you help me get out of this? I don't feel it went so well. I'd love to come back. And it's not to say DIY can't be done. It's been done well before the industry, and still today it's the majority of investments that happen. But it's the fact that when the top investors have got that momentum, have got the goal, have got the plan, they just want it done, and they want it done with the minimal headaches, the minimal time consumption, and the minimal energy, so they can focus on the whole reason they're doing it for: family, loved ones, their weekends back, or excelling in the thing that got them to that position, their careers, their businesses. Very few businesses are likely to be successful in the way they are if their business is focused on from their energy and their output, and suddenly they give half of it for the next 5 years because they're busy building another business or their own time. They don't usually excel in the way that they could if they were locked in and focused there.
And this comes back to this idea of conceptually being a CEO of your own property company. Do you want to be a sole trader? And that's what you're talking about there, where they're just doing it all by themselves, and the CEO that does everything typically is a business that doesn't grow. You might get a wage out of it, or you can build a scalable business, and that's acting and operating like a CEO and using a team around you. Fortunately, you don't have to hire them and over those HR headaches, you can use them all as contractors and consultants. It's all contingent, right? So you build a big contingent team out, which costs you when you're actually manufacturing stuff.
Yeah.
But what I would say with property investment is that the best advisors I know keep connected and engaged, and they're never thinking about is the clock on or off. They're there to support and champion you, and there will be a point in time when there's something where there's a transaction for the service provided. But no doubt, if I was an InvestorKit client, I wouldn't just do something with you, then you'd be gone into the sunset, right? You'd be engaging, connected, and working with you for the next thing.
Yeah, absolutely. Right. And so I think like that whole team aspect there is the difference between, someone going at it and then really having no controls in their decision-making matrix. And I think that's a key as well. When you build a team around you, there's controls in place. There's like guardrails. I always consider 10-pin bowling. A team around you is just the gutters up.
Yeah.
Like the gutter rails,
bumpers.
the bumpers, they're going up. That's the team. Like even if you do just make a decision off the back of a quick phone call, the accountant's there, the broker's there, the right structure, the right finance, your buyer's agent's there, the right area, the right due diligence. Yeah. Things will flow through and happen.
Well, that's it. You're still going to bump around a bit, but the likelihood of hitting the pin's a lot higher.
Yeah.
Same logic. Arjun, always enjoy seeing you, mate. Thanks
you,
so
mate.
much for sharing your insights, and we're doing some cool stuff in the background as well, which we'll be able to share with our listeners and viewers at a point in time as well. You'll no doubt see it before you hear us talking about it, but
absolutely.
I look forward to that. How do people track you down if they just want to say good day and see what you're up to?
Yeah, look, investorkit.com.au. Jump on there for a free consultation with our team. But if you want to connect with myself, I'm on LinkedIn all the time. Drop me a DM, Arjun Paliwal, always sharing content, bit of behind the scenes, what we're getting up to with the stuff on Nine and a few other things, and sharing some research and insights as well as the head of research at InvestorKit.
Brilliant. Thank you.
Thank you.
Thanks for tuning in, everyone. Remember to smartpropertyinvestment.com.au. If you like what we're doing, please, those reviews coming through. I know everyone at InvestorKit's going to be doing it after tuning into this podcast, whichever podcast player they tune into. Social media, you'll find us. Just look up Smart Property Investment, track it down. Like us, follow us, send messages. We like all that good stuff. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.